Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is August 24th. It's my wife's birthday, actually. If you want to wish her a happy birthday, send me an email. Also, post comments, feedback. I want to hear from you. I want to make sure you guys are liking this video. Let me know if I'm on the right track, if I'm helping you out, and let me know what else you'd like to see it. Either post a comment below this video or send me an email. It doesn't cost you anything. support@marketgeeks.com. I love hearing from you. I really do. Now, the market's opening up pretty flat, or at least appears it will. Now, we still have a lot of things on our docket before the market opens, including the durable good orders. Now, last revision, we came in at 1.9. It was revised at 2. Now we're looking at a consensus of 0.5. That's a lot lower. I'm hoping that the number's a little bit better because that's going to put a little pressure on the stock market. We definitely want to see an increase in orders because A, it'll show that foreign economies are strengthening and we're able to get our orders in. Also, it'll reflect on the bottleneck, supply chain bottleneck. Actually, the most important would be transportation. But again, it'll be very interesting to see how it drops. It drops in about 35 minutes. And for now, the markets are rather flat. I mean, as you can see here, the Dow's up 5 points overnight. NASDAQ is up 15. And the S&P is meeting us halfway in between. Now, aside from durable good orders, we had a new home sales report yesterday, and the numbers were bad. And that's a dangerous sign because, again, one of the biggest signs that America is going into a recession or declining in its stability is decline in new home sales, but that may cause the Fed to offset rates a little bit or slow things down. But as you can see here, we were looking at 540, 610. We came in at 511. That's a bad number. I'm hoping that number is just end of summer. Summer sales are a little slow. But today, we're going to get the pending home index at 10, petroleum report, and the durable good orders. And tomorrow, we have the big daddy. We have the GDP, and this is going to reflect on the quarterly growth. And I'll talk more about this as we get closer to that date in my report tomorrow. Make sure you pay attention to it. And then we've got jobless claims. And Mr. I don't know, things are going to go great till I get reelected or reappointed. And then once I get reappointed, I'll then tell you the truth, Powell. Don't get me started with him. But we'll get into all of that later. We got a lot of fish to fry this week. The market has a lot of hurdles to go through. Now, in terms of earnings, we've got Salesforce and Snow. Let's take a quick look. Just take a little sneak peek here. Snow, let's see how Snow's doing right now. Let's see if it's snowing. Not really reflecting anything, up $1.50, up 58 cents. Then we've got Salesforce. Ooh, that's a big one. Let's see, Salesforce. CRM, right? Duh. We use Salesforce, and honestly, I'm not a big fan. Also, not really doing anything major. I don't know if the earnings are coming out afterwards, but so far they're pretty tame. But we also have Nvidia. So there's a lot of, you got Autodesk, you've got Guess, you've got Petco. That'll be very interesting. Splunk. I know somebody who trades this stock a lot. Williams-Sonoma, little retailers, a little Victoria's Secrets, and Nvidia. Let's see if Nvidia is doing anything. Nvidia, and also so stocks are getting off with a very slow start. But again, just so you could see here what the expectations are, Salesforce is looking at $1.02 per share. Snowflake is looking at, they're looking at a loss of 1 cent per share. So not really anything crazy. And here you could see the numbers for Nvidia. They're looking at 49 cents, which is not a lot. Petco's looking at 22 cents. Splunk is looking at negative 35 cents. Williams-Sonoma, $3.47. And Victoria's Secret squeezing by a little less than $1. All right, now, inside of that, there's a lot of stuff going on. Now, the biggest factor that I'm looking at right now, I'm going to tell you what it is. Look at the bond market. It's still within this area right here. Now, there's no question that consumer discretionary is cooling off. We were at 97% of stocks trading above the 50-day moving average. We're now at 79. It's now opposite. We had this at 23%. Now it's at 16. A lot of these sectors right here are going to start looking a lot like this. So you've got to be very, 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 very cautious right now because we're going to come down. Now, I want to show you something interesting. It's something you need to pay attention to. And this is important, really important. Now, a while back, before we rallied, or when we rallied, I told you guys that the market's going to have a very difficult time going through this. This is when the CPI came in at 8.6 and the market just dumped. And that's when we realized we were in a worse situation than we were right now. And this was a very important resistance area. And I said, if the market, I said, I don't think the market can overcome that area. And if you look at the bond market, it didn't. It bounced right here all the way down. But certain sectors did not. And if you look at that resistance area right now, guess what happened yesterday? We broke back into it. We're back into it, which I predicted we would. When we broke out of it, I said, it's too much too fast. We're going to come back into it. And guess what? We're now back into that level. So here is something interesting. So if you look at QQQ, again, you'll notice that we're back in that zone. Everywhere you look, all I have to do is draw this line that I drew a while back, and you'll see we're back in this zone. So the question now remains, look at XLY, all of this. Just look at that hump, that 8.6 hump, which I drew here. I drew this here for you a long time ago. So I think all of these stocks, the consumer stocks, the tech stocks, they're all going to come back down within this zone. Most of the indices are already in that zone. The Dow is holding back because it doesn't have as much exposure to retail. But I'm telling you right now, I believe all of these stocks are going to hit that area, that 8.6 area, which is actually right here. I don't know why I drew that there, which is right there. So we're already in that area. And here, if you look at the individual sectors, you will see that here's that hump. Energy doesn't count because energy never went above. It went below that hump. Now it's recovering. But look at financial. Here's that hump right there. See, we're in that hump. Consumer staples, we're not in that hump. Remember, these are the defensive sectors. Industrial, looks like we're right there. Look at technology, right there. See that? We're at that crucial level. And that's why I'm saying this is really important. And if you see us drop lower, which I think we will at this point, we go right back into that zone. See that? Look at that. So let me just draw that where it's supposed to be. That. So I think what's going to happen is we're going to come right back down and we're going to go back into that channel very similarly to what we've been seeing with the bond market. Stocks just can't get too far ahead of bonds. And when you take into account the momentum levels that I'm showing you guys, it's almost a certainty that the market is going to revert, because look at how much weakness you have at the 200-day moving average. So to me, it looks like stocks are going to go back into that range and continue their choppiness for the foreseeable future. Now, with that said, energy, utilities, the two leading sectors. Now look on a monthly basis what's going on. Energy and utilities. Remember, there was a lot of noise, a lot of consumer discretionary. I told you it's all going to straighten out, and it is. So energy and utilities on a monthly and on a cumulative. Don't be surprised to see consumer discretionary drop down, technology drop down, and where's my consumer staples start coming up, and let's see here, healthcare start coming up, and consumer discretionary and technology start cooling off on a monthly and on a cumulative basis. Again, if you look at the stock market, and we'll take a look at it here, you will see that the heat map, it's been, look at, this is yesterday, look at 5 days. Energy, utilities, consumer staples. See that? Defensive. Look at a 1 month. See how consumer discretionary is starting to go a little lower? Let's go 3 months. It should be, yeah. Look at that. Consumer discretionary, technology. But 5 days, energy, utilities, consumer staples. 1 month, already consumer discretionary is coming down. I'm telling you right now, we're going to revert back to the market that we saw in March and April, where we had more fear of a downside, because the bond market going down, stocks are going to go down. Put to call ratio is still elevated. Investors are still buying a lot more puts than calls. Nothing has changed. Volatility is increasing. It's starting to come up. And as the markets start coming back into this channel, right, on the way down, volatility is going to start popping up above this channel. Very, very, very important. So I'm bullish volatility right now. Now, let's talk a little bit about global economy, kind of put all of this together. Singapore released earlier in the week data showing inflation was still strong. Core inflation headed higher to 4.8% year over year. They're not seeing a slowdown. Food prices inflation was at 6.1%. That's not happiness. In the U.S., a report on new home sales, that's what I was talking about, that came out yesterday, set off pessimism about possible imminent recession. Folks, that pessimism was already built into the market. That report just confirmed things. A slowdown in American economy would be devastating for export-resilient Asia. That's right. It all works together. The next big event circled on calendar is the speech on Friday by Mr. I'm going to predict the future, Jerome Powell. He'll be speaking at the symposium in Wyoming, which has been the site of major market-moving speeches. It'll be very interesting to hear what he has to say. Most likely he'll say things are looking slightly better, spending is good, but we're still not out of danger zone, and we're going to keep the pressure at 0.75 or maybe 0.5. Not sure, but I think nothing major is going to change. Volatility has returned to Wall Street following what has been a strong summer as worries rise about how aggressively the Federal Reserve will raise rates to knock down inflation. Recent comments from Fed officials have cooled hopes that the Fed may end up less forceful than feared. Yeah, I don't think that's going to happen. They're on a mission now. The housing industry has been one of the hardest hit by this year's turnaround as the Fed jacked up its key overnight rates. Mortgage rates climbed too and put a chill on the industry. Such weak data on the U.S. economy worries that a recession may indeed be on the way. But you know what, folks? While energy is moving higher, more fear of inflation than a recession. We're not back that. It's not that bad yet. If it was that bad, then you would see energies declining too, and they're not. They're rising. But also could encourage the Fed to take it easy on rate hikes. Worries about slowing economy stretch around the world, and the value of €1 dropped below 1 have been concerns about Europe in particular. Oh, can't barely read today. Now, folks, we got to be very, very careful, and we have to be strategic. As I showed you, sectors are coming back into that level, into that congestion, into that consolidation level. And that's got me worried, which means we have to be defensive. So, energy, strongest sector, consumer discretionary, weakest sector, right? Or tech, consumer discretionary, communication services, that's where the weakness is. Consumer discretionary weakness, strength in energy, consumer staples, and utilities, right? We know that. So, strength, Enphase. I want to show you guys this. Look at what my strongest stock right now. I want to show you, I'm not playing games here. Look at what my strongest stock is, Enphase Energy. Look at what I'm recommending. It cooled off the last couple of days. It went from 309 to 275, and I think it's going to come back up. So I'm really recommending this, and if it drops below the 271 level, it's probably not going to be as strong of a trade. But I like this, and I think it's coming up back up. And if you look at what this company does, it's not really a semiconductor company. It's a global energy company that's focused on delivering solar and utilities and energy to the infotech sector. So it's really more energy-based than anything. But I get it if you're not happy about this stock because it may not be, 100% focused on what we're doing. That's okay. I've got you covered as well. Let me show you something. I've always got you covered. You've got UNM. Great company. And take a look at this stock. Kind of pulling back for 3 days. Usually after a 2-3 day pullback, it comes back up. And if you look at what this company does, it's healthcare, insurance. So these are the strongest stocks. If you want to stay in the energy sectors, and that's okay too, you've got Oxy, right? And you've got Quanta. Quanta is a great stock. It's a utility stock. And guess what? We're long this stock right now in one of the programs. But you could see here, Quanta, I like it. I think this is a pivot point. I think we're going to come back up in the next day or two. Again, I'm bullish this stock. On the downside, folks, Expedia. I think it's going to continue going down and break below the 50-day moving average and come back to the 84, 85 level. Honestly, I hate this stock. And if you want other stocks, look at this. Let me give you some names that you've heard many times. Dish. Do you guys remember me talking bad things about Dish? I'm saying it again. How about Royal Caribbean? How about Expedia? How about Norwegian? How about Caesars Entertainment? Out of all of them, I actually don't like Expedia because it gave us some good hope. It went all the way from 87 to 116, and now it's coming back down, and I think it's going to go from 105 all the way to 88. I think we're going to hit new lows. And look, we never went above that hump. That hump, never even went close to it. Strong downtrend. Summer's almost behind us. Just don't see a lot of love for this stock. So number one stock, if you want to be really safe, Quanta, utility stock, power, ticker symbol, and in the downside, EXPE. Now, before I let you go, and again, I want to hear comments from you. I want to know if I'm helping you. I spend 10 to 15 minutes every day doing this. I want to make sure you're getting your money's worth. Folks, joy of the trade, Jeff Zananeri, he's been working on a brand new way to trade. When I saw it, I got jealous. I loved it. And in doing so, he's found something that I think you'll find very interesting. And honestly, you know, when he told me about it and when I read about it, I thought it was so obvious. I couldn't believe I didn't come up with it. I'm jealous. But, you know, good for Jeff. This is really great, and it's a no-brainer. And I trade technically like this all the time, but he's got it. He decoded this sucker for you guys. I mean, he's making it like he did an amazing job. I'm going to just leave it at that. And you guys need to follow the link below to learn it. But let me tell you what it's about. This guy noticed there was an abnormality, a large abnormality move that it happens before stocks, before an analyst posts a new rating in the same direction. Options often skyrocket in the same stock days later. Now, Jeff has spent nearly 2 decades on Wall Street, and in all of his years of trading, he's never seen anything like this. He's revealing all the details of what he's found and how you could trade in this special workshop. He's going to give you all the info, meat and potatoes, really good stock. He's going to show you how these analysts upgrade or downgrade stocks and how you could take advantage of taking the other side. Man, I love this. This is worth its weight in gold. I really, really do. Remember what I always tell you? Analysts' expectations. Analysts is what moves stocks. The expectation, not the actual move, the expectation. Well, Jeff figured out how to take advantage of it probably 100 times better than I ever could. Follow the link below. Check it out. Learn about his workshop. All meat and potatoes. And post comments below this video. I want to hear from you. Bye, guys. Have a great, great day. We're closer to Friday than we were 2 days ago. Bye, guys. I'm going to go celebrate my wife's birthday. I'll see you guys later. Bye.